Good afternoon and welcome to the end of week market review for July 19th, 2013. You're going to see that both our US and Canadian markets are rising bullish. Taking a look at our agenda, we've got a few things that we're going to be covering off today. First off, we're going to be taking a look at the market news and see how that's been affecting the US markets. We're then going to go ahead and take a look at some economic reports, which will finish our fundamental analysis. Once we've done that, we're going to go ahead and take a look at some daily and weekly charts for both the S&P 500 and the Toronto Stock Exchange. While we look at the weekly charts, we're going to be looking both short-term and long-term. After that, we'll be looking at our volatility indicator, which will help us identify just how much volatility is in the current marketplace. And then finally, we will be finishing things off by taking a look at one of our great picks. Alright, so we can see that the markets did end up finishing the week on a positive note. We've got the Dow Jones up 0.51% from last week's close, and the S&P 500 up 0.71% from last week's close. Most of the gains that we've had have been from positive earnings, though there certainly have been a few times throughout the week where some of the companies, some major bellwethers, did end up with some negative earnings. All in all, though, some of the major bellwethers, such as Citigroup, did end up posting some good positive earnings, which definitely helped push the markets up. Taking a look at some other sides of the market, we can see that the oil has gone up 2.09% from last week's close. This puts it to $108.47 per barrel. We've got silver up 3.34% from last week. This puts it to $19.49 per ounce. And then finally, we have gold up 0.98% from last week. This puts it to $1,292.60 per ounce. If you take a look at the US-Canadian pair, you're going to see that it is currently down 0.34%. This puts it to 1.0369 pips. Right now, we're taking a look at the economic reports for last week. The one thing that we really like to focus in on is the jobless reports. We can see that they claimed 334,000 versus the expected 345,000. Because they're lower than expected, that means there were fewer people claiming unemployment, and as a result, we ended up with some good positive data coming from here. We never want to see that it's meeting or exceeding the briefing forecast. All right, we're going to go ahead now and take a look at the S&P 500. Right now, we're looking at it on a daily chart with about 6 months worth of data. You're going to see that last week we did break up above this resistance line, which is now acting as support. And this was the line that represented the cycle high. Right now, we don't have anything else that we could reference to for cycle highs. We're charting into uncharted territory. The MACD did end up slowing down a little bit through the middle of the week, but is now rising bullish again with the black line over top of the blue line. Because it slowed down, though, you can see that the dotted blue line is catching up, which means that if we have a pullback, it won't take as much for that black line to cross down below the blue line. We will expect a pullback at some point, though. We've had a very long run. We need to pull back, regroup, and then work ourselves up again. All right, we're shifting gears here now. We're taking a look at the S&P 500 on the weekly chart, and this time we're looking at about a year's worth of data. You're going to see that we've pushed through, and this is the second week now where we've spent above that cycle high. How much longer we're going to spend up above there is really going to depend on earnings right now. This final chart for the S&P 500 goes right back to 2004, and this is a great example of where the S&P 500 has been and where it's going. Right now, we really have nothing that we could reference to all the way back to 2004 as far as our charts go. But you can see very clearly that back in 2004, the markets were quite low. So we would suspect that there's at least a couple of years where they're also just as low. which means we could possibly going back to 2002 or even 2000s, where we don't see cycle highs as high as they are right here. With that said, it means that we are going to be in a very volatile state where we have nothing to reference to and we're trading off of emotion and news. We really have nothing that we could reference through on a technical analysis point that will help guide us. This is good though. It means the markets are very bullish and there's very likely more profits to be had. We're now going to go back to the daily chart and we're looking at the Toronto Stock Exchange this time. We can see that things are going pretty good for the TSX. It had a very good last couple of days, but it is coming up against some overhead resistance, which is a cycle high around 12,800. You can see that its MACD is rising bullish and with its black line over top of the blue line. What's important to note here though is that the TSX is not going through the same type of gains as the Toronto Stock Exchange. This becomes obvious when we shift into the weekly chart. You can see that we've had a fairly good several months here, but we've definitely not been breaking through and charting into uncharted territory. In fact, you can see that we've got a cycle high that's around 14,000 that we would need to cross before we can say that we're at an all-time high. And then if we go back all the way to a chart to 2002, you can see that it's actually got some overhead resistance or cycle highs around 15,000. So there's a lot of ground that needs to be covered before we can say the TSX is in the same boat as the S&P 500. All right, going back to our daily chart, we're taking a look at the volatility indicator, which we use to help gauge the amount of volatility in the US markets. You're going to see that it's down 9.36% from last week's close. This puts it to 12.54. When we look at the volatility indicator, we know that the markets or the industry will use it as a gauge, where once it gets into the 30s, we would see a very volatile market state. We can still use this indicator on a shorter term though. You're going to see that for the most part, when the markets were stable, they were trading between 12 and 14. Obviously, when things were starting to get a little bit shaky, the volatility indicator did work itself up into the 20s for just a couple of days. Right now, we could use this indicator and say that it's definitely a safe position right now, as long as it stays below the 200 EMA. If it crosses up above the 200 EMA, then we can see that the markets are probably going through some type of turmoil, some type of news which is driving the markets to be as volatile as they are, and we would trade with caution. Once it levels back down, gets below the 200 EMA, then we can start thinking about trading more aggressively. All right, and now we'd like to bring up one of our great picks that we had. This was actually from July 16th. You're going to see the symbol is CRK. This was one of our US ITL picks. It ended up earning 1.25% in 2 days. If you can see where my mouse is pointing here, this is the date that it was on the watch list. The next day, the order was filled. And then finally, on Thursday, the order would have closed for a nice, good, strong profit. If anybody was using our MWA disciplines, you would have been able to even see greater profits. So with that said, if you have any further questions, make sure that you either send us an email or you can call us. Both our email address and phone number are listed on the screen. This has been the end of week market review for July 19th, 2013. Ciao for now.